What's up, YouTube? Welcome to the Credit Plug channel where we talk about how to build credit, how to establish relationships with banks and financial institutions, and most importantly, how to get you access to high limit credit funding. If that's something you like to listen to, we welcome you to subscribe. Otherwise, you can support our channel if you just like, share, comment down below. It helps our content get out to a wider audience, and we greatly appreciate the support. As a reminder, I know we have a lot of new subscribers. I get a ton of questions and comments on various different topics that we've covered. So I encourage a lot of you guys to check out some of our older videos. There's a lot of great information hidden in those. So definitely, go check those out. So for today's video, I wanted to give you guys some valuable information. So a couple months ago, I did a webinar on how to trigger automatic credit approvals that has a lot of great information. Some of the strategies that I've implemented myself as well as with other clients in order to get a lot of success when it comes to applications and things like that and getting credit funding. So I know, like I mentioned, a lot of you guys are new. So I was just going to share with you guys my most recent application spree back in April when I was able to get over $76,000 in the course of 8 days. But before I get into that, I wanted to go over some important things when it comes to getting credit funding, at least my strategies, right? So, as a lot of you know, I cover a lot of credit unions, and there's a reason why. I know there's a lot of other bigger YouTubers out there, and they kind of focus more so on the big banks, right? The Chase, American Express, Wells Fargo, Bank of America, etc., right? The reason why I focus on credit unions is because there's actually a competitive advantage when it comes to getting funding with credit unions versus with large banks, and I'm going to explain exactly why. So with large banks, they usually cover, the entire country or, large regions of the country. So when you apply for a credit card with, let's say, Bank of America, for example, the underwriting guidelines are going to be the same for everyone, regardless if you live in New York, LA, Washington, Florida, Texas. It's going to be universal, right? And usually it's going to be an automated application where, you enter in your information. It's usually stated income, and then they're going to give you a decision, usually immediately, or if not within 24 hours, right? One of the advantages with credit unions typically serve a much smaller geographic footprint. So the underwriting for credit unions is going to be a little bit different. And I'm not talking about like the large credit unions, right? I'm talking about some of these smaller credit unions that serve maybe just that particular state or even like a zip code or a couple of counties or what have you. So these credit unions are normally their underwriting is going to be reflective of their local social economics and demographics. So you take certain states, and I'm not picking on any states, but you take certain states like Alabama, Louisiana, Mississippi. These states have the lowest average FICO scores. I mean, they're in the bottom five in FICO Vantage scores, in the country. So the local institutions in these particular areas, they can't necessarily set the bar too high when it comes to underwriting. And the reason why, for example, if the average credit score in, Alabama is a 650, 660, they can't make it the requirement be that you have a 720 because then they would be alienating over half of the people that they're intending to serve. So the competitive advantage comes when you have a higher credit quality than the average borrower for that particular area or region, specifically when it comes to credit unions. And the opposite can work against you, right? So if you go to an area, I don't know, Beverly Hills or just a high income area where, you're usually going to have higher credit profiles and things like that. They're going to set the criteria a little bit higher. So it works both ways, but you can use it to your advantage, if you're able to get into some of these institutions where, that particular zip code or that particular state has an average lower, FICO score, Vantage score, whatever, right? Lower credit quality because the Underwriting for those local financial institutions are going to be much more reflective of their local demographics. So you could take that and use that to your advantage. So like if the average in, Louisiana is a 650 and you have a 750, by default, you're going to be in a much higher position compared to their average borrower. You're going to be much more qualified than the average borrower, and that's where the advantage comes in. So I'm going to share with you guys how I was able to get over $76,000 over the course of 8 days. So, and I'll post some links in the description. So, one of those institutions was AODFCU. I was able to get a $10,000 line of credit as well as a $10,000 credit card from them. And that was just with one inquiry. Rural King Harvest Visa, I did a video on that. $10,000 business credit card. And then also I got SCCU, $15,000 Visa signature, as well as a $10,000 line of credit, and a $5,000 shared secured loan. So another advantage when it comes to credit unions, if some credit unions allow inquiries to be good for anywhere from 30 to 60 days. So that means you can use the same hard pull. They're using the same report basically for additional applications. So you don't have to undergo another hard pull. So the reason why that's important is because with every hard pull, it's going to pull down your credit score, as well as the more inquiries that an institution sees, it's the more likely that they're going to deny you, right? Especially if they see a lot within a short period of time. So over the course of this application spree, I was able to get $76,000, right, between 10 or 9 different accounts. I guess 10 if you want to count the shared secured loan, which I put my own money into. But yeah, so at 4 of these institutions, I was able to get at least 2 accounts. One, I was able to get 3. So I was also able to get $7,500 credit card, platinum credit card from Alliance, as well as a $5,000 loan. NIH FCU, I was able to get a $6,000 total, but I was able to get a line of credit as well as a credit card. And then what else? Oh yeah, and then I was also able to get the Sportsman Guide Visa for $2,500. So all in all, I was able to get $76,000 over an 8-day period using only 5 inquiries. So I used 3 from Equifax. AOD was Equifax, SECU was Equifax, NIHFCU was Equifax, Alliant was TransUnion, and Rural King Harvest, which was backed by Redstone Federal Credit Union, was Experian. So a total of, so that's an average of about $15,200 on average per inquiry, if you want to look at it that way. So all in all, like I said, I was able to get 10 new accounts with 5 inquiries. That's the difference between a credit union versus a big bank. If you apply at a big bank, if you go to Chase and apply for a credit card today, they're going to pull your credit. You apply tomorrow, they're going to pull your credit again. And so that's one of the disadvantages with working with large institutions, is that they don't usually, I haven't come across anywhere they allow the same hard pull, for the next day or the next week, or what have you. So that's one of the key things, and it allows you to be efficient, because one of the things, like I mentioned, those inquiries from those additional counts not showing up will help you as well. And then another strategy that I utilize is synchronized applications. That's where you pull 2 applications up at the same time, and knowing beforehand what bureau those applications are going to be pulling from, and you want to do it so that they pull from the same exact bureau, right? If you're pulling from applications from different bureaus, it doesn't make sense to do it that way. So what you would do is you pull up the 2 applications, you fill out the information, and you hit them simultaneously. The key with this is that you want those applications querying the credit bureau's database roughly around the same time, because there's a short window of opportunity, because it takes less than 10 seconds between the time you submit an application to the time when that inquiry posts on your credit report. So ideally, what you want to accomplish with the synchronized application is that you want both applications pulling the identical report, right? Because you're gonna the second application, and they're not going to hit at the same time because it's a queue, right? So there's an order, and they have it by the millisecond, so it's not going to be exactly the same, but there's a couple second lag between when that report is pulled to when that inquiry actually posts to your credit profile. So like if you did the applications 5 minutes apart, by the time the second application hits, it's going to see the inquiry from the first application. So that's why you have to do it simultaneously, and there's a short window of opportunity. So, for example, I did this with SCCU and NIHFCU, and so they both hit roughly at the same time. So I forget which one hit first, but they were basically the identical credit report, credit score. They both used the FICO 5 from Equifax. So yeah, and the reason why that's so important is because you know you don't, with each additional inquiry, it lowers the chances of getting approved. So that's one of the things. And with the synchronized apps, you really don't want to do it like doing it with 3 and 4 isn't going to work, because by the time the third one it gets pulled, it's going to see the first one and vice versa. So this really only works with like 2 applications for it to be effective. But yeah, I mean that's basically the advantage, when working with credit unions versus big banks. Credit unions overall are just going to be much more lenient. So, they're usually going to give you higher relative limits than what you would get at like a large institution. Large institutions tend to cater more towards prime credit or people with high deposits. And don't get me wrong, like I have relationships with the big banks too, but the way in which I built my credit, I started with the big banks first, and then went to the credit unions. But yeah, so I mean, and another thing too, the most important thing aside from all these other strategies when it comes to getting funding is you have to build a relationship, right? Especially now with the current economic climate and environment, right? You got to build a relationship. Just kind of joining and applying without a relationship is going to be a lot harder going forward than it has been. And I've seen that just from some of the inquiries I received, about individuals trying to go about funding. So when you build that relationship, your credit score starts to matter less. I mean, obviously, you have to have a good profile, but then another thing too, and this is really important too, when it comes to the recent spree that I had back in late April. I was in the garden since October of 2019, and that's another key point. You have to garden. So if your credit report has a lot of new accounts, like from a month ago, 2 months ago, doesn't matter. You could have a 780 and it's still going to cause issues for you, because the way the banks look at that is, okay, you just got X amount from this particular institution. Why do you need more from us right now? They want to see how you handle that account for a certain period of time. So any account less than 3 months old is considered a new account. So you're going to want to generally garden for at least 6 months before you go on more application sprees. And ideally, when you apply, you should definitely get them all out of the way at once, or within a relative short period of time, because once those new accounts start to show up, it's really going to hinder you, regardless of what your credit score is, right? So when you do plan on going about getting funded, at least my strategy is to get the applications in at the same time, or not exactly the same time, but like let's say within a week, right, before they start to post to your credit. And then another reason why you want to do that too is because you'd want ideally your accounts to grow together, right? You're going to get dinged with the average age, right? That's inevitable. But if you space out applications and accounts, it's only going to it's only going to affect you more as opposed to just taking that upfront, hit on your average age and letting those accounts age together. So then as you add more accounts later down the road, it's less of an impact on your average age. So anyways, that's all I wanted to share with you guys in this video. Until next time, y'all take it easy and let me know in the comment section down below, what's been your recent experience with, funding. And, I know a lot of subscribers have actually, adopted the same sort of strategies. So definitely let me know what you guys think in the comment section right down below. Till next time, y'all take it easy and we'll talk to you soon. Peace.